The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. We will give it just another minute since we have people still coming on. Good afternoon, everyone. Thank you for joining today's webinar, providing an overview of the interim rule for the agricultural lands easement component of the Agricultural Conservation Easement Program, or ACEP-ALE. American Farmland Trust and Land Trust Alliance are pleased to be co-hosting this webinar with USDA's Natural Resources Conservation Service. My name is Cris Coffin. I am AFT's Senior Policy Advisor and Director of our National Agricultural Land Network. I'm excited to be joined by Lori Faeth, Government Relations Director for Land Trust Alliance, who will co-moderate with me. And you won't hear them, but here with me are several staff from AFT's Farmland Information Center to help make this webinar run smoothly. We have a great NRCS team from the Easement Programs Division with us today. Presenting will be Matthew Forgue, NRCS Realty Specialist and Team Leader, and Jessica Groves, NRCS Natural Resources Specialist. Joining them to answer questions at the end of their presentation will be Jerome Faulkner, National ALE Program Leader, and Lisa McCauley, NRCS Easement Programs Specialist. Before we get started, let's review just a few logistical items. First, we've muted all attendees to avoid problems with feedback, so you don't need to worry about barking dogs or any other things that are in your background. If you have a technical issue, you can't hear us, or you can't see the screen, or you can't figure out how to ask a question, please use the Raise Your Hand feature in the control panel on the right-hand side of your screen. We will respond to you via the chat function that is also in that control panel. During the webinar, feel free to ask questions using the question feature. This is also in the control panel on the right-hand side. It may be minimized, so you need to expand the box, and when you do that, you'll be able to type your question and send it to us. Following the presentation, we'll try to get through as many questions as we can. Finally, we will be recording the webinar, which will be posted on both the Farmland Information Center and LTA websites. The Farmland Information Center will also be posting additional materials, such as the program manual, as it becomes available. We will send a link to these materials out to all webinar registrants once they've been posted. With that, I think we're ready to begin, so I will turn it over now to our first presenter, Matthew Forgue with NRCS.
All right, thank you, Cris. And hopefully everybody can hear me, and if not, I hope somebody will interrupt me. So this is Matthew Forgue. I'm with the Easement Acquisitions Branch of the Easement Programs Division of NRCS. I will be one of your presenters today, along with Jessica Groves, who is on the policy branch of the Easement Programs Division at NRCS. Before we get started, I do have a little disclaimer that I would like to make to everybody. So as hopefully you all know, the interim rule has been published and is currently in its comments period. A number of additional details will be publicly available pending the publication of the ACEP policy, which we publish to our eDirectives website, and we disseminate that out to the states, and then the states can disseminate it out to interested parties such as all of you. So that policy will take the form of the ACEP program manual, and also an ACEP national bulletin, at least one, maybe multiple ACEP national bulletins for specific implementation in this fiscal year, 2020. So that implementation bulletin will include documents like the ALE agreement statements of work, the FY 2020 minimum deed terms, and some forms that go along with those, like the CPA 230, which is the statement to certify matching funds, and the SF 270, which is the supplement for payment requests, that kind of lists out all the documents that are necessary for closing. So the material in this session is going to be largely based on the ACEP interim rule, but we may have some items in here that are sourced from draft policy. And so those items are potentially subject to change between now and the time that the ACEP policy comes out, is published. So for that reason, until such time as those additional policy materials are published, only the recording of this session is going to be made available. And please be aware that any items that we discuss in here that are not matters of regulation may be subject to change when the policy comes out. And then once the ACEP policy is published, these slides, or an updated version of them as needed, will be made available upon request. So without further ado, I think we can jump into the next slide, which is a roadmap of the presentation. So here we've listed out the topics that we're going to cover today. I'm going to cover the first three, and then Jessica is going to cover the rest. So I'll be starting off with the eligible entity contribution requirements, moving into changes to the ALE deed, and then to the ALE plan. And then Jessica is going to pick up with ACEP-ALE ranking, the changes to the process for entity certification, the ALE agreement types and cost share contracts that will be that we'll have available in 2020, and finally a brief overview of the buy, protect, sell provisions. Next slide, please. So jumping straight into the non-federal share and eligible entity contribution requirements, also known as the cash match requirements. Next slide, please. I'll be talking about the updates to these requirements from the 2018 Farm Bill, and I'll start us off with a recap from the 2014 Farm Bill. I believe many of you are probably familiar with this process, but under the 2014 Farm Bill, please remember that the federal share was limited to 50% of the fair market value of the easement for general ALE, and then for grasslands with special environmental significance, that could go up to 75%. Throughout this presentation, we'll refer to grasslands of special environmental significance as GSS. So, you know, that was 50% of the fair market value, and then the rest was a non-federal share. So the non-federal share needed to be at least equivalent to the federal share, or for GSS, it could be a third of the federal share. Now, of that non-federal share, there needed to be a cash contribution from the eligible entity. And for general ALE, that was 50%. For GSS, it was 16.67%. And that cash contribution needed to come from the entity and not from sources attributable to the landowner. Next slide, please. So continuing the recap of the 2014 Farm Bill, we had a waiver that was available for projects of special environmental significance in order to reduce that entity cash match requirement. That waiver is still available if you're closing a parcel that was enrolled under a 2014 Farm Bill agreement. So that's parcels under agreements that were signed in 2014 through 2018. So for unclosed parcels under those agreements, you can still get that waiver. Also under the 2014 Farm Bill, the landowner donation was considered to be any amount of the fair market value that was not already covered by the federal share or the entity's cash contribution. That has not changed or does not need to have changed under the 2018 Farm Bill, and I'll sort of elaborate on that in a bit. So just to recap or to reiterate, the 2014 Farm Bill, non-federal share and the cash contribution requirements, all of that still applies to all of your unclosed parcels that were enrolled under the 2014 Farm Bill ALE agreements. Next slide, please. Okay, so what has changed under the 2018 Farm Bill? First, I'll tell you what has not changed. So the way that the federal share is calculated and the limit of the federal share are the same. The federal share is still limited to 50% of the fair market value of the ALE for general ALE or 75% for GSS. That has not changed. And the fair market value of the easement is still determined solely by the appraisal that is approved by NRCS. It cannot be inflated by other costs, such as expenses incurred by the eligible entity. And similarly, the federal share is not affected by such other costs. So that's the federal share. The non-federal share has undergone some changes. For general ALE, it still must be at least equivalent to the federal share, and for GSS, it needs to comprise the remainder of the fair market value after accounting for the federal share. But now that non-federal share can be comprised of several different components, actually 4 components. Next slide, please. And here are the 4 components. So this is how the non-federal share is calculated under the 2018 Farm Bill. As I said, there's 4 components. The first one being the eligible entity's cash contribution. So that's, you may seem familiar from the 2014 Farm Bill. It is very similar, except that now there is no longer a minimum eligible entity cash contribution. So that's number 1. Number 2 is the landowner's donation or charitable contribution. So this is essentially the landowner's willingness to take a reduced easement purchase price below the fair market value of the easement as determined by the appraisal. So we believe that the majority of easements, ALEs, will meet their non-federal share using categories 1 and 2. There will, however, possibly be some that do not. In those cases, when the non-federal share minimum requirement is not met by 1 or 2, you can move on to category number 3, which is the procured costs that the eligible entity pays to a third party in order to procure certain easement acquisition related items. And I will run through the details on that in a future slide. But that is sort of your next option if 1 and 2 don't get you to the minimum non-federal share. If 1, 2, and 3 still do not get you to the minimum non-federal share, you can use item number 4 there, which are costs incurred by the eligible entity for monitoring and stewardship up to 2% of the fair market value of the easement. So the way that that the non-federal share is calculated, or essentially how much money falls into, sorry, can we go back to slide 4, or the last slide? Thank you. The way that the non-federal share is calculated, and essentially how much money falls into each of these 4 silos, is going to be estimated on the CPA 41A, which is the parcel application form, and it will be confirmed on the form that's called the CPA 230, or the confirmation of matching funds form. Those will be new forms for 2018 enrollments, and as I mentioned earlier, they'll be coming out with the fiscal year 2020 implementation guidance. I just want to remind everybody, and you'll hear me say this multiple times, that the funds contributed, any funds contributed by the landowner can only count toward item number 2. If the landowner contributes funds toward, 1, 3, or 4, then they can't be counted toward the non-federal share. Okay, now move on to the next slide, please. Thank you very much. So let's go into detail about each of these different 4 categories of non-federal share. So the biggest change in the 2018 Farm Bill to the ALE cost share is the elimination of the eligible entity cash match requirement. There's no longer a minimum requirement for this. There has not been a change to what constitutes the eligible entity cash, only a change in the required minimum. So instead, entity cash contributions may be awarded points in the ranking process. Just a reminder, or something new rather, if the entity cash contribution is less than 10% of the fair market value, so again, there's no minimum, it doesn't have to be 50% of the federal share anymore, but if it's going to be less than 10% of the fair market value, we require the entity to provide evidence of their capacity to monitor and enforce the ALE, just to make sure that that's something that's within the resources of the entity. And then also just another reminder that this needs to come from sources attributable to the entity, and these funds cannot come from the landowner. Next slide, please. Okay, so silo number 2, the landowner donation. So for the 2018 Farm Bill, the landowner donation toward the easement value can come in the form of a charitable donation or a qualified conservation contribution. So NRCS is not in a position or qualified to give tax advice to eligible entities or to landowners. And so we will not be giving advice about what qualifies as a qualified contribution. We do not collect or require any evidence that a landowner donation for ACEP-ALE purposes meets the requirements of a donation or contribution for IRS purposes. And so having said all that, the landowner donation from our perspective can be any portion of the fair market value of the ALE that is not already covered by the federal share or the entity cash contribution. So the entity can count all of that as a landowner donation. Anything above the fair market, the federal share plus the entity cash can count as the landowner donation. But you're not required to count it that way. And again, a reminder that the landowner donation does not include any landowner contributions or costs paid for the acquisition-related items or other expenses of the eligible entity. So that's the landowner donation. Next slide, please. Thank you. So the next silo is item number 3. The only reason we would get to the silo is if items number 1 and 2 do not meet the minimum requirement for the non-federal share. But if that is the situation, then you can count certain acquisition-related expenses incurred by the eligible entity and paid to a third party toward the non-federal share. When I say certain acquisition-related expenses, this is the list of them right there in the middle of the slide. So it's the appraisal, the survey, the full phase 1 environmental evaluation, title commitment, title insurance, and other closing costs. Any of these items that are going to count toward the non-federal share need to meet NRCS standards and specifications. So for example, appraisals would have to be approved by NRCS through our technical appraisal review process. If you get an appraisal and it's not approved by NRCS or it doesn't meet our standards and specifications, then you wouldn't be able to count it toward the non-federal share. So in order to count these, we also require that receipts or invoices be provided. That's only required if you're actually going to rely on these expenses in order to meet the non-federal share. So although you may be, obtaining these services or items from third parties, if you're not counting that cost toward the non-federal share, then you don't need to send us the receipts, only if you're actually going to count it toward the non-federal share. And so the document that requires those receipts is the SF-270 supplement, which, as I mentioned earlier, is the form that is submitted to request payment and kind of lists out the documents that are needed, that we need in order to make that payment. So that's the document that kind of lists out, the receipts that are needed in order to count this toward the non-federal share. And that will be an exhibit to the ALE agreement. And as with other categories of non-federal share, these costs must actually be costs that are expended by the eligible entity. They cannot come from the landowner. And also to clarify, that list in the middle of the slide is the list of items that can count toward this category. So administrative costs, costs associated with reviewing these items, or other expenses not related to these items do not count toward the non-federal share. Next slide, please. And finally, the fourth silo, or the fourth category of non-federal share, is the eligible entity cost for easement monitoring and stewardship. So this item will only be used if items 1, 2, and 3 still do not get us to the minimum non-federal share. Now this item is limited to 2% of the fair market value. Of course, it cannot come from contributions provided by the landowner. Next slide, please. So here we have some examples of how the easement contributions can be calculated under the 2018 Farm Bill. This slide is for general ALE, so the federal share is limited to 50% of the fair market value of the easement. And all four of these columns represent, valid scenarios for calculating the contribution requirements under the 2018 Farm Bill. If you look at the left-hand column, the one that begins with 500,000, moves to an eligible entity cash contribution of 100,000, and a landowner donation of 150,000. That, I think, will be a very common type of scenario. And if you look at it closely, you'll notice that it is unique to the 2018 Farm Bill. So under the 2014 Farm Bill, that eligible entity cash contribution would have been too low if you've got a federal share of $250,000. But because there's no minimum eligible entity cash contribution under the 2018 Farm Bill, this is a valid calculation of contributions. Another thing I want to point out about these examples, if you look at the third column, the one that's 500,000 at the top and then 70,000 eligible entity cash contribution, this is one that includes all four of the categories of different types of non-federal share. And also this one is interesting because it shows how the federal share can be limited by the non-federal share. So in this case, although the fair market value is $500,000, generally that would allow the federal share to go up to $250,000, right? That's 50%. But because the non-federal share must be at least equivalent to the federal share, if we can only get to a non-federal share of $200,000, then the federal share is similarly limited to $200,000. Okay, next slide, please. So this is another set of examples. This one is for GSS. Won't linger too long on this, except just to point out that, as you can see in the next to last row, the federal share is higher for these because on GSS, the federal share is limited to 75% of the fair market value. And again, if you look at that third column, you can see a situation where, although the federal share could have been higher in order to get to 75%, it's limited by the non-federal share of the easement contribution. Okay, next slide, please. Okay, running a little bit into the 2019 ALEs. So 2019 was a transition year, and I'll talk a little bit in this part of the presentation about how that works for cash contributions, and then I'll talk later about how that works for the deed terms. So under the 2019 ALE agreements, these parcels had an option to follow either the 2014 Farm Bill cash contribution requirements or the 2018 federal share requirements. So if you've got unclosed 2019 ALE parcels, you can choose to use either one of those. But if you want to go with the 2018 non-federal share option that I just kind of laid out, then you're going to need to amend your agreement. So get in touch with your state NRCS staff and let them know that you're going to want to amend your agreement in order to add the new payment request forms. So to kind of clarify that, those agreements in 2019 had a CPA 230 and an SF 270 attached to them. Those were the old forms. They did not contemplate this new non-federal share calculation scenario that exists under the interim rule that has been published and will exist under the policy when it comes out. So when the new forms come out, there will be a new 230 and a new 270. We need to swap those out on your ALE agreement in order for you to be able to use them and use the new cash contribution paradigm. So that will require an amendment to the agreement. If you want to continue to use the 2014 Farm Bill cash contribution requirements, then you won't need to amend the agreement. Okay, next slide, please. Thank you. So moving on from cash contribution and into the ALE deed. Next slide. So again, I will recap a little bit what the situation was under the 2014 Farm Bill. So under that Farm Bill, all of those parcels were subject to the regulatory deed requirements that were promulgated under the 2014 Farm Bill. That is still true for those parcels that remain to be closed. If your parcel was on a cooperative agreement, it needed to be subject to the minimum deed terms, and there were a number of ways to do that. But those minimum deed terms were intended to make sure that the regulatory deed requirements are met. You may also have had an ALE deed template under the 2014 Farm Bill. Those templates were approved for use under the 2014 Farm Bill only. They cannot be used for parcels that will be enrolled under the 2018 Farm Bill, so that's the FY 2019 and forward. But they still can be used for your old parcels under your 2014 ALE agreements. Parcels that were enrolled on grant agreements under the 2014 Farm Bills, that's with certified entities. They were able to use their own deed terms as long as they met the regulatory deed requirements. And so just to sort of reiterate or remind everybody, those minimum deed terms that were from the 2014 Farm Bill cannot now be used under 2018 Farm Bill enrollments, but they can still be used for your old parcels under the 2014 Farm Bill. Next slide, please. And to sort of add a little bit more detail to that, so entities that use the minimum deed terms were required to incorporate the language specified by NRCS into their own conservation easement deeds through the attachment or incorporation of the minimum deed terms or through a national headquarters approved template, deed template. So non-certified entities needed to do that in order to use the minimum deed terms. As I mentioned, certified entities were able to use their own deed terms as long as they met the regulatory deed requirements. But certified entities were still required to use the U.S. right of enforcement language verbatim. So that was true under the 14 Farm Bill. That is all still true under the 2018 Farm Bill, except that you can't carry over those old minimum deed terms and those old templates into the 2018 Farm Bill, except for parcels that were enrolled under those old agreements. Next slide, please. So getting into what has changed under the 2018 Farm Bill. So there are new regulatory deed requirements, and there will be new minimum deed terms that will be promulgated under the 2018 Farm Bill. So changes in those new regulatory deed requirements and minimum deed terms include different statutory mineral development language. So we had some limited mineral development language under the old minimum deed terms, but the 2018 Farm Bill added some specific requirements, including the requirement for a mineral development plan, which must include a plan for remediation, and a requirement that disturbed areas must be restored pursuant to the remediation plan. So those have found their way into the regulatory deed requirements now. We have updated the U.S. right of enforcement language. Specifically, we have restricted the U.S. right of inspection as required under the 2018 Farm Bill to only apply in situations where the entity has failed to monitor, or NRCS can express a quote, reasonable and articulable belief that there has been a violation of the terms of the easement. And then also, if NRCS is going to exercise its right of inspection, it needs to notify the landowner and the holder of the ALE before doing so. So those are a couple of changes. More changes include changes to the ALE plan. As I will describe on future slides, there is no longer a requirement that the ALE be subject to an ALE plan. So that has been removed from the minimum deed terms, except for properties that have highly erodible cropland, in which place a conservation plan is still required. As I will describe later on, although the ALE is no longer subject to an ALE plan, the entity may wish to have a plan and may wish to, there may be an opportunity to obtain ranking points for having a plan. If that is the case and the entity has agreed to specific deed provisions or other terms in order to earn ranking points, then those requirements must be included in the terms of the deed. So that's made available in the regulatory deed requirements. And then also the regulatory deed requirements have an opportunity for entity drafted terms that are intended to keep the property under ownership by a farmer or rancher. Next slide, please. So, and I have gone through a little bit of this, so I will keep it relatively brief, but basically if you have minimum deed terms that were approved or a template that was approved under the 2014 Farm Bill, it can still only be used for those parcels that were enrolled under the 2014 Farm Bill, which may include some parcels that are still out there unclosed. There will be new 2018 Farm Bill minimum deed terms. A set was published in 2019. A set will be published this year, 2020. Those, you can't use those for old parcels that were enrolled under the 2014 Farm Bill, but you can under new parcels that were enrolled under the 2018 Farm Bill. For the unclosed parcels on your fiscal year 2019 agreements, you may choose to use either the fiscal year 2019 minimum deed terms that were attached to those agreements or the most current minimum deed terms that are approved for use under the 2018 Farm Bill. So in other words, when we come out with the new minimum deed terms this year in 2020, you can use those for your 2019 enrollments, but you need to amend your agreement in order to do so because that agreement had the 2019 minimum deed terms attached. And so we'd have to swap them out with the 2020 minimum deed terms. Next slide, please. Okay, moving into updates to the ALE plan. Next, please. Thank you. So I'll recap a little bit for the 2014 Farm Bill. As you may remember, any ALEs that were enrolled under the 2014 Farm Bill needed to be subject to an ALE plan. That is still true. So all of those older parcels, if you have not closed them yet, or even if you have closed them, they are still all subject to the ALE plan. And that includes any component plans that were required, grassland plans, forest management plan, conservation plans for highly erodible cropland. So the easement was subject to the plan, is subject to the plan if it's under a 2014 Farm Bill agreement. And those plans needed to be and will need to be approved by NRCS, and NRCS is available to provide technical assistance in developing those plans. Next slide, please. So what's different under the 2018 Farm Bill? Well, the really big difference is that the ALEs are no longer required to be subject to the ALE plan. So if you've got ALEs that were enrolled under the 2018 Farm Bill, that ALE plan requirement does not exist anymore, except in the context of highly erodible cropland where an HEL conservation plan is still required. Next slide, please. So although the requirement that an ACEP-ALE be subject to an ALE plan has been removed, the manager's report to the 2018 Farm Bill did indicate a desire for USDA and eligible entities to encourage conservation planning. So for that reason, an entity may still elect to develop an ALE plan. That ALE plan may be comprised of one or more components. Here are some optional components, one being a comprehensive general ALE plan that describes the natural resource concerns and the measures and practices to address them. Two being a grassland management plan, not required, although optional, except for GSS parcels that were enrolled in fiscal year 2019. And for those parcels, the ALE agreements specify that they must have a grassland management plan. For any other parcels enrolled under the 2018 Farm Bill, the grassland management plan is optional. Another component is the forest management plan. And a fourth component is an ACEP-ALE conservation plan. That one is required, as I mentioned, for properties that contain highly erodible cropland. Next slide, please. So if an entity does elect to develop an ALE plan other than an ACEP-ALE conservation plan for highly erodible cropland, then they may be awarded points in the ranking of the parcel. This is an option that NRCS states have to include this as a ranking criteria. If a parcel receives ranking points because of the entity's election to develop an ALE plan, then the ACEP-ALE easement terms must be included that require the plan to be updated as needed over the life of the easement. So that has been put into the minimum deed terms as sort of an option to use if the entity is elected to develop a plan in order to obtain ranking points. And while that's true that the deed terms must require the plan to exist if the entity is elected to receive ranking points for developing one, the easement itself is still not subject to the plan unless the entity separately requires that on their own. Next slide, please. So some more requirements if the entity elects to develop an ALE plan in order to receive ranking points, it must be signed by the entity and the landowner prior to closing the ALE. NRCS is no longer able to provide technical assistance for the development of the plan except for a conservation plan for highly erodible cropland. Although we may review it, review the plan that was developed by the entity if requested and as our time and resources permit. Next slide, please. And I believe that is the end of my portion of the presentation, and Jessica will pick it up with the updates to ranking.
Okay, thanks, Matthew. Hello, everyone. This is Jessica Groves with the Easement Programs Division in NRCS. And I'll cover the remainder of the topics that were on our roadmap for today, and then we'll get to some questions. So a couple of quick slides on some of the updates that are occurring in the ranking world for ACEP-ALE. To answer a couple of questions that we received prior to this webinar, just to make it clear for everybody, ranking of individual ALE parcels is a thing that occurs and always has occurred at the state level. So there's no national consolidation of ALE applications to be ranked at the national level. That all happens at the individual state level, and then the states make those selections on which parcels get funded based on the outcomes of their ranking and allocations and other things. So the way the ALE ranking works is there are both national and state ranking criteria, and those are identified in the ACEP Interim Rule. So the national ranking criteria that are provided must be addressed in all of the rankings, and the criteria themselves cannot be modified. However, the states, in developing their ranking factors, can, for some of those criteria, modify how the question itself is posed. So the specific ranking question that gets asked to answer or address the ranking criteria is specified at the state level, as is the weighting of those individual criteria. So the states can look at all of the national criteria, identify their relative importance based on the concerns and the issues going on within the individual state, and set the weights of those individual criteria for the national components. And then those national components have to comprise at least half the total points that are available. Then the companion piece to that are state ranking criteria, also provided in the interim rule. You can see the list there of the ranking criteria that the states can then again develop tailored ranking questions based on questions that best address those criteria for the states, and similarly set the weighting of those individual criteria. So that is how the ranking sort of worksheets themselves, the series of questions that get asked to prioritize the various projects, are set up at the state level. So a few new things for the 2018 Farm Bill in terms of changes to those ranking criteria. As Matthew talked about, the consideration of entity cash contributions has been added as a national ranking criteria. So as a national ranking criteria, that is one that must appear in all of the rankings. And again, the states can then attribute the respective weight of that particular criteria within their state ranking worksheets. And then the remainder of these all sit on the state criteria side, but have been added, a couple of them specifically in response to items that were added in the statute. So for example, the statute allowed state criteria based on geographic differences, provided that those criteria allow for the selection of parcels that achieve ALE purposes and maximize the benefit of the federal investment. Previously, NRCS, we included this flexibility for states to develop these criteria. The statute added these specific requirements that any such criteria accomplish these two things, that they achieve the purposes and maximize the benefits. Additionally, there was language to focus on measures that maintain or increase agricultural viability as ranking considerations. So we've added that to the list of state ranking criteria. So those now may include things like ALE plans that the entity elects to develop, like Matthew just discussed. May also include things like succession plans, certain entity deed terms, and again, those are going to be the specific questions that are drawn out at the state level to address these potential optional criteria. And then consistent with the ranking criteria previously, now just identified in the regulation that the states can also include a ranking factor to recognize entities that regularly meet their agreement and monitoring requirements. Okay, so I will move on to eligible entity certification updates. Under the 2018 Farm Bill, there were two new criteria, or two new pathways added under which an entity may qualify for certification. So the three pathways that now exist. Number one existed previously, that an entity hold at least 25 agricultural land conservation easements. The two that were added is an eligible entity accredited by the Land Trust Accreditation Commission or a State Department of Ag or other state agency that's got authority for farm and ranch land protection. A couple of details there that were similarly specified in the regulation. If coming in through the second pathway there, through accreditation, that accreditation, the entities will be asked as part of the certification. Those that request certification would include in that request package documentation that accreditation is in good standing. So if there are other statuses to the accreditation, conditional, probationary, some of those kinds of things, there will be additional documentation required to speak to the status of entity accreditation. That said, if an entity falls outside of that first pathway of holding at least 25 agricultural land easements, still exists. That's still available for any entity interested in certification. And so for all three of those pathways, whether you're coming in with 25 easements generally, you're an accredited land trust, or you're a state agency, there are additional criteria that must be met for any entity requesting certification under ACEP-ALE, and that includes that the entity hold at least 10 ACEP agricultural land easements or predecessor program easements, FRPP, Farm and Ranch Land Protection Program easements. So for example, previously of those 25, previously actually the requirement was 5, that was changed to 10 in the statute, so that's now been replicated for all three pathways. but of those 25, at least 10 of those would have been evidence of interaction with this particular federal program or its predecessors. Similarly, to qualify for certification, the entity needs to have demonstrated compliance with the program requirements as part of the easements that it holds currently under the ALE or predecessor programs, and then meet all the other various requirements for certification, including things like agreeing to use NRCS easement valuation methodologies, an assessment of timeliness in transactions, maintaining the capacity to monitor and enforce the easements, and otherwise demonstrating an ability to comply with the various easement requirements. So the benefits of certification are that the entity certainly plays a much more independent role in completing the easement acquisition. NRCS doesn't review any of the transaction items prior to closing, and so the entity is able to proceed with each transaction far more independently once certified. Additionally, certified entities can use their own deed terms. So in contrast to the use of the minimum deed terms that Matthew explained, which are attached to the cooperative agreement, under a grant agreement used by a certified entity, the requirement is simply that the regulatory deed requirements that appear in the ACEP regulation are met in whatever terms the entity crafts. The entities are certainly, a certified entity is certainly welcome to use the minimum deed terms that NRCS has crafted. So that's certainly a good indication of the kinds of provisions that would be needed to ensure that the regulatory deed requirements are met. But the certified entity may also use their own terms crafted in such a way that those terms ensure that the regulatory deed requirements are met. The exception is that the U.S. right of enforcement clause has to be used verbatim so that that U.S. right of enforcement clause is consistent across all ACEP-ALE deeds, irrespective of the status of the entity acquiring them. So because the entity is operating without any transactional oversight or interaction really with NRCS as the transaction is proceeding, the terms of the grant agreement that a certified entity would enter into identify the post-closing quality assurance reviews that would happen. So there is a review of the transactions themselves, a percentage of the transactions closed in a given year are reviewed if by NRCS. If there are issues identified, NRCS then works very closely with the entity to identify whatever those issues are. There are identified periods to cure. And then if the items aren't remedied, NRCS has sort of options to continue to work with the entity to figure out what the appropriate next steps are in terms of whether the entity would continue to purchase ALEs still remaining on that agreement without approval, or if it becomes a situation where the relationship becomes much more traditional again and the entity functions more like a regular eligible entity rather than a certified entity, or depending on the extent of the issues, there are paths to decertification or other administrative steps needed to remedy the deficiency. And then there's also a general quality assurance review of the certified entity itself, so not as much a transactional review, just to make sure that the certification criteria continue to be met, and that happens a minimum of 1 in 3 years. Okay, moving into ALE agreement types. So for fiscal year 20, we are excited to roll out a new agreement option under which ALE can be implemented and administered. We piloted the program agreement approach in fiscal year 2019. This is one of the items that, like Matthew mentioned, is sort of pending publication of the policy itself. So what you'll see in these next few slides about program agreements, at this point, your NRCS folks in the states don't have a whole lot more information than this either, but as the manual, the ACEP policy manual itself, as well as the specific guidance bulletins that will be provided are published. All of those are publicly available, but also will provide additional training and information on rolling out these options for fiscal year 20. But in the meantime, to give you a preview of what's coming, is that now there are 3 agreement types available under ALE. So there's this program agreement option, which is available to any type of eligible entity, certified or non. There is the ALE cooperative agreement option. This is the traditional cooperative agreement, again, available to any eligible entity type. And then there's the ALE grant agreement available to those entities that have requested and received certification under ALE. So just some quick sort of details to be able to compare and contrast the traditional cooperative grant agreement approach to what I'll share with you about the program agreements. So under a cooperative or grant agreement, all of the parcels on which the easements will be acquired need to be identified and determined eligible at the time the agreement itself is executed or through a subsequent amendment to that cooperative or grant agreement. As a result, because those parcels have been identified, determined eligible, all parties have agreed to move forward. The funds are then obligated to the agreement itself. So the agreement is the obligating document, as we call it within NRCS. And then any changes to the agreement, any exhibits to the agreement, to the parcels that are identified on that agreement, et cetera, require an amendment to the agreement itself. So everything resides in and rests in the agreement. It also then necessitates separate agreements based on the parcel type, and this will be true for 2018 Farm Bill enrollments as well, is that if the parcels being acquired are general ALE parcels, those all are housed under one cooperative agreement, and any grassland of special environmental significance parcels are housed under a different agreement. Similarly, transactions, now that we have 2 transaction types under ALE, what we'll call a standard transaction and the new buy, protect, sell transactions, same situation there, is that the cooperative or grant agreements will need to be separate based on what the transaction for that particular parcel type will look like. And then in terms of the review and processing internal to USDA, those go through both NRCS, which many of you are accustomed to, and then they also go through our new FPAC Business Center. The Grants and Agreements Division that was formerly housed within NRCS has been moved into the FPAC Business Center. So there's a few more, I'm going to say, cross-agency touch points to get the agreements and then any of the amendments to the agreements processed. So in contrast, the ALE program agreement concept is a single 3 to 5 year agreement with an eligible entity to acquire the easements. The primary purpose and function of the program agreement itself is to identify all the potential parties to any potential easement transactions. So those roles that are contemplated for any potential easement transactions are those of the eligible entity, those of a co-holder, so a legal entity that may be in a co-holding grantee position on the deed, but is not necessarily is not an eligible entity or is not considered a participant in the program, et cetera, but is identified on the deed itself. and similarly third-party right holders. So those are the potential roles contemplated in the program agreement. Those parties and their respective roles are all identified in the program agreement. And that's a one-time deal. And so the agreement gets executed, it identifies the potential parties, it includes some of the standard language that you will have seen previously in the cooperative and the grant agreements, with the exception of a lot of the sort of transactional information has been removed, which I'll explain in a minute. But the other thing that the program agreement allows is, because it's a much more, since it's much more based on identifying the relationships of all the potential and prospective parties, there's also the option to add additional details if the entity wants to elaborate on how particular transactions would be structured. We're not prescribing anything there, but it does include the option to go into further detail with respect to how all of the various parties would interact. So what happens then is that the funds themselves are obligated at the individual parcel level through what we're calling ACEP-ALE parcel contracts. The function then of this is that the individual parcels themselves can be, but do not have to be, identified at the time of the agreement execution. So if the agreement is really about establishing and identifying the prospective parties that will be part of any transaction that might happen, the parcels themselves are really not anything that has to be sort of considered in the construction of the agreement itself. And so then the individual parcels come along at any time once the agreement's been entered into. So that one-time agreement is executed, it exists. Then the parcel applications can come in at any time and can be entered into at any time. There's no requirement for them all to be listed on an attachment to anything. They all function independently, which then means that within a given program agreement, it can include individual parcel contracts for different parcel types. So general ALE enrollments, parcels, GSS parcels. It can also accommodate different transaction types, all under the same agreement, because the specifics of the transaction are actually handled at the contract level. It does mean that the funds are not obligated to the program agreement. So then the function of that is that once the agreement is entered into, it continues to persist. The funds themselves are attached to these individual parcel contracts. One of the outgrowths of that then is that there are relatively few events that would trigger any sort of need to amend the agreement itself. And there are no amendments needed for any changes related to individual parcels. So a little about sort of what that relationship potentially looks like. An entity application has to be submitted one time, and then once the agreement is executed, it persists for that 3 to 5 year period. The only attachment that has to be sort of separately filled out to the agreement required is that one that identifies the various entities that may be party either to the agreement itself, which would be any identified eligible entities, as well as any co-holders potentially identified. And then it also lists the potential third-party right holders. So a sort of relationship that could be conceived of is that you're a land trust, you operate over the entire state, you may interact regularly with multiple counties across that state. They may generally be co-holders to your transactions, they might be third-party right holders, and then you may also interact frequently with your State Department of Ag, who, when they provide funding, have a role as a third-party right holder. So if you have this sort of regular suite of partners and other entities that you work with in your various transactions, at the program agreement level, you would identify those prospective parties. Again, you do not have to identify the parcels that any of those parties would interact with. It's effectively sort of a menu of your partners that you frequently work with, obtain funding from, whatever their roles are. That's what you would be identifying in this attachment to the program agreement itself. So the program agreement is executed, and then you're ready with parcel applications. Given that this is year one, those parcel applications could all be submitted at the same time you submit your entity application to enter into the agreement. They don't have to. You could submit your entity application for the agreement and say, I would like to get into this agreement, and the parcel applications can wait. But if everything's ready, that's great. It can all happen at one time. So the agreement is executed, and then through this series of cost share contracts, the various individual parcels are selected for funding, the contract is executed, and then the parties specific to that particular parcel are identified on those individual contracts. So in this example, if your entity application is submitted in April 2020 of this year, in the coming months, the agreement is executed in June. Let's say in 2020, you're ready to go with one of your parcels at the same time you submit your entity application. You can go ahead and submit that at the same time in April 2020. So once that program agreement's been executed, we can also move on to executing the associated cost share contract. Under the program agreement, you have identified yourself as the eligible entity. You've identified that you have 3 potential co-holders that may interact on various parcels, on individual parcels, and 4 third-party right holders that may interact on various parcels in the future. For this parcel that is submitted in fiscal year 20, the entity always has to be identified, the eligible entity always has to be identified, and then you're identifying that the co-holder 1 and 2 from your agreement are going to be party to this particular parcel. Those are all executed, the funds are obligated to the cost share contract itself, and we move forward with that particular transaction. Next fiscal year, 2021, early in the fiscal year, November 2020, you're ready with your next parcel. You submit the application to NRCS. NRCS will still have ranking and application periods and things like that, but once that ranking period is concluded and the selections are made, we can move forward with executing that individual cost share contract at that time. The only thing that's needed is the parcel application. The entity application does not have to be resubmitted. We do not have to revisit the program agreement itself. It is just a matter of now adding this next cost share contract to the agreement. For this next cost share contract, you're going to identify yourself as the entity. Co-holder number 3 in this particular instance will be listed for this particular transaction, and third-party holder number 2 from the program agreement will be identified on this transaction, and so on and so forth. So what it does is it sort of severs the concept of having to have all of your parcels and your applications and everything already at the same time, and it allows NRCS, I think, to be far more responsive to the applications as they're submitted, and then go through and select, fund, manage those contracts through time. So just a quick comparison to the agreement execution piece of this. Many of you are familiar with what happens under the cooperative grant agreement side of things. The right-hand side just sort of shows some of the comparison items that would be needed to enter into the program agreement. So eligible entity documentation, designation of program technical contact, those are still needed for both agreement types. Then the differences start. So under a cooperative agreement, the entity application and all of the individual parcel applications have to be submitted at the time that the agreement is being requested and entered into. The attachment to the agreement for a cooperative agreement identifies all the parcels, all of the standard forms that go with it. And then these agreements are subject to grants and agreements regulations, all of those 2 CFRs listed there, which is why they go through our FPAC Business Center Grants and Agreements Division. On the ALE program agreement side, only an entity application is needed at the time of entering into an agreement. The attachment to the agreement just lists the various entities that would be involved in the transactions associated with that agreement. It could include, the agreement could include optional provisions negotiated between NRCS and the entity. Because a certified entity can also take advantage of the program agreement option, for those entities that have requested and received certification, there would just be a statement attached that for this particular program agreement, you can avail yourselves of the certified entity provisions. And then the parcel contracts themselves can be executed at any time. So some quick additional information about these individual parcel cost share contracts. So the funds and the parcels themselves are identified on these contracts, not on the program agreement. Again, this will simplify the agreement process, minimizes the events that would require an amendment to the agreement itself. And for those of you that are familiar with our other NRCS programs, things like EQIP or conservation stewardship, the model is similar to that used for other cost share programs, which is why there's a one-to-one relationship between the cost share contract and the parcel. So each parcel has its own contract. The contract includes whatever information is specific to that parcel, acres, landowners, what kind of parcel it is, a general, a GSS, the type of transaction that it would be, a standard or a buy, protect, sell, and any other details particular to that particular parcel. And then under that contract, once the parcel is acquired and the payment is made, the contract is completed. There's no action needed at the ALE agreement level. If there's funds remaining, those are deobligated and made available to fund other projects through other contracts. So it means that the parcels can be selected over at any time over the life of the agreement. Once the agreement's entered into, the parcel selection and funding can begin relative to allocation cycles and ranking sign-up periods and things of that nature. So the fund availability is associated with the parcel contract, and then if there are changes to the individual parcels, they're handled through a modification process. So again, those of you that are familiar with our financial assistance programs, the contract modification process is far simpler than an agreement amendment process, but it's through those modifications that we can handle things like changes in landowners, if there are extensions needed, to change the expiration date of the contract, if there are in scope, if there are cost share adjustments that are within the scope of the contract, if there are changes to the manner in which the deed will be processed. So for example, if you're going to use a different set of minimum deed terms, or if after the contract is executed, you have a template that is approved, that's all handled through a modification to the contract rather than an amendment to the agreement. And then these contracts have also been set up to handle the parcel substitutions. So if for whatever reason that particular easement on that parcel does not come to fruition, because we have the authority and the flexibility to substitute those parcels, that happens at the individual contract level. Okay. Last but not least, the new buy, protect, sell transaction option. And what I'll cover today falls primarily into what's covered in the interim rule. So this is another situation where the state NRCS folks do not have a whole lot more information on these than what I'll present here at this point, but this is part of the additional guidance that will be published in the coming weeks through both the policy manual for ACEP, as well as the fiscal year 20 guidance that will be specific to buy, protect, sell transactions. So there will be more published material coming, and additional training will be provided as well. But to give you just a quick overview in the meantime, so as I'm sure many of you know, the 2018 Farm Bill included a new transaction type that can occur under ALE. These are called buy, protect, sell transactions. The definition has been provided in the interim rule, and that's what's shown here: a legal arrangement between an eligible entity and NRCS on land that's owned or being purchased by an eligible entity on a transitional basis. So this is one of the significant changes, or one of the significant features of these transactions, is that the eligible entity sits in an owner position at the point at which we enter into either the agreement or the contract to provide funds for the purchase of an easement on this particular parcel. During the entity's ownership of that land, an ag land easement will be secured, and then the ownership of that land transferred to a qualified farmer or rancher. So there are a couple of conditions that are applicable to all buy, protect, sell transactions. They must be private or tribal land, meaning this option is not available for entities that are state or local governments, at least in the ownership position. That's not to say you couldn't have a state or local, an eligible entity that's a state or local government involved in the transaction, but they couldn't be the owner at the outset of the transaction. The property has to be subject to conditions that necessitate the transaction. So these are things like imminent threat of development, or a landowner that is perhaps unwilling to sell the agricultural land easements themselves, but is willing to sell the land itself to the eligible entity, and and the protection of that land is critical to achieve the ALE program purposes. The entity then has to own that land either at the time the agreement or contract, in the case of a program agreement, is executed, or within 12 months of such time. There is the requirement that the entity sell the fee title of the land to a qualified farmer or rancher at the lesser of either the appraised agricultural value or the original purchase price paid by the entity. That sale to the farmer or rancher can include holding and transaction costs that don't exceed 10% of the appraised ag value. And then the other requirement is that the entity cannot be both the fee title landowner and the easement holder at the same time. And so therefore, there are two transaction types that are explained to some extent in the interim rule. So what we have framed are that there's a pre-closing buy, protect, sell transaction wherein the transfer of the ownership of the property to that qualified farmer or rancher occurs at or before the ACEP-ALE closing. So in this case, things like eligibility, landowner eligibility, for example, we would hold off until the eligible entity lets us know who that qualified farmer or rancher buyer is going to be, and we can then work to do the necessary program eligibility, landowner eligibility determinations on those identified buyers. One of the stipulations with these particular transaction type then is that the ALE funds would be provided as a reimbursement, so that we can ensure that all of the various requirements, qualified farmer or rancher, they meet the landowner eligibility requirements, the sale happened at ag value, et cetera, that all of those requirements that are particular to these transaction types have indeed occurred, so that we don't have to get into cost recovery or remediation type issues. Alternatively, there are post-closing buy, protect, sell transaction option where the transfer of that fee title ownership would take place after the ACEP-ALE easement has closed. And so then this is where we enter into the issue of the eligible entity not able to both hold the easement and fee title ownership of the land at the same time. Therefore, for these particular transactions, and there will be much more guidance on this, what we will need from any applicant interested in this particular transaction type is the outline and the information on how you are proposing to structure this transaction to ensure that that doesn't happen. And we, in the interim rule, there's a significant discussion on this in the preamble of the various types of relationships that could potentially exist. So for example, if the eligible entity owns the land at the time of application, but then at the time the easement closes, the eligible entity has the option to continue to sit in that ownership role and have a third party, someone else, hold the easement in the interim while a buyer, a qualified farmer or rancher is being found during that 3-year period, is sort of one example of how that could potentially be structured. The converse could also be the case where the eligible entity at the time the easement closes moves from that ownership position into the easement holder position, but would need to then find basically an interim landowner to sit in that landowner position. And so we would need the details on what's being proposed, and then NRCS would review the structure being proposed to ensure that those transactions conform with the various requirements. NRCS would review those with our Office of General Counsel and then approve those transactions and work with the entity on any, I think, details that need to be sort of sussed out on those on a case-by-case basis, which is part of the reason that at least under cooperative and grant agreements, that those are going to be limited to single transactions. So under a cooperative or a grant agreement for a buy, protect, sell, those are going to be limited to single transactions, whereas on a program agreement, because we enter into the contract on a parcel-by-parcel basis, those particulars to that transaction would just be associated with that individual contract. Okay. So with all of that, just a general piece of information. So I think hopefully all of you know, but if not, the ACEP Interim Rule was published to the Federal Register on January 6th. There was a correction document published on January 24. However, that didn't make any changes to the rule itself. There was a docket number error in the first version of the rule that was published, so that was fixed. But what it did include was 2 additional sort of specific requests for public comment on a couple of particular topics. So in general, the bulk of what you want to look at is in that interim rule, but for that additional information, you can go to that correction document. All of that is available at that website below at the regulations.gov. And then if you search for the docket ID number that's provided there. With the correction document, it did extend the comment period. So the comment period for the ACEP interim rule runs through March 20. And then all of those comments are publicly available, and then we'll go through all of those. And one thing I would like to mention is that for those of you that are going to submit comments, it's helpful to hear both about the things that work well, as well as those where there could potentially be improvement or where there are questions, where we could provide clarification. But it helps to hear sort of all of the above, so that things that are working well don't inadvertently get changed. And then for those that have room for improvement or adjustment, that we can work through those items. That's all I have.
Great. Thank you so much, Jessica. And this is Lori Faeth with the Land Trust Alliance. And thank you, everybody, for participating today. And really extra thanks to Jessica and Matthew for this excellent presentation, and to Lisa and Jerome for being here to help with questions and just helping with this. We are at 3:50. We did schedule this till 4. We all are happy to stay a little longer. We don't have a lot of questions, but we thought we would go ahead and ask some of them. But do know that for those questions that the agency is able to answer based on what was in the interim rule, if your question wasn't answered on this call, we will consolidate them and get back to everybody that participated with answers to them. And then some of the questions will need to wait until they come out with the policy and kind of other follow-up documents. So with that, let's start with the first question. What would be an example of a state criteria based on geographical differences? And Jessica, or Matthew, if you could answer that.
Sure. Let's see. I mean, I would say there's kind of there's a range of possibilities. But if, for example, the state, in working with their state technical committee and partners, either identify certain geographic areas or certain land use types, perhaps there's a particular type of agricultural use that goes on in the state that's, unique or particularly imperiled, or whatever the issue is. Those would be the kinds of things where the state NRCS folks working with partners could say, we really need to make sure that our ranking questions adequately get after whatever this priority is that we've identified. So I will say, from the national level, we are not terribly prescriptive about what a state could potentially include in these categories.
Great, thank you. Then the next question is, we have a 2019 GSS enrollment which has not yet closed. Please confirm what will be required in relation to an ALE plan and/or grasslands management plan. Thank you.
Sure, this is Matthew. So for 2019 GSS enrollments, you will need a grassland management plan. Other components of the ALE plan will not be required unless there's also highly erodible cropland, in which case an HEL conservation plan is also required.
Thanks, Matthew. This is Jerome. Also, Matthew, there is the option to use the 2020 deed terms in the 2019 agreements. Those deed terms are yet published, but the agreement terms did allow them to use the interim, what was going to be the upcoming interim rule deed terms also.
Great, thank you. Okay, the next question, if you co-hold easements, do both entities have to be certified to work through the certified entity process?
This is Jessica. So it depends, would be the answer. It depends on whether or not both holders want to participate as entities. So for example, if both entities want to be able to receive direct payment, then they've got to meet the requirements as, at a minimum, an eligible entity. In order for, so maybe I should back up here. In our concept of the co-holder, what we mean by that is you have a legal entity. They may or may not meet the requirements of being an eligible entity, but if the extent of the role that they want to play is that they're going to be identified as a grantee on the deed, but not necessarily be a participant in ALE, so that's to say they wouldn't receive the funds directly, those kinds of things. That's what we consider, that's what we mean when we say co-holder. If, however, you have two eligible entities that want to both to co-hold that easement with each other, and one of those entities is certified, I'm guessing your question is, do both of those entities have to be certified? I don't know that we've encountered that scenario yet. So I think we'll probably need to discuss that internally. But at a minimum, we need at least one eligible entity that's going to be the holder of the easement. If that entity is certified, it will sort of depend on what capacity that other entity is operating in, whether they are also operating as an eligible entity or whether they are simply sitting in sort of that co-holder seat. So we will work on that one and get back to you if that doesn't answer your question.
Thanks, Jessica. Okay, the next question is regarding pathways to being an eligible entity. Can the 25 easements that must be held be conservation restrictions or a combination of ag easement and conservation easement?
Yes. There are actually, so in the policy that exists now, because this 25 easement path was what existed previously, there's some policy, you can actually look to our existing policy there in terms of some of the flexibilities that exist for what those 25 holdings can be comprised of.
Thank you. Okay. The next question is, one challenge we've had on the handful of FRPP ACEP-ALE transactions we've completed or have in the works is understanding where we're at in the process and then being able to relay a timeline to parcel landowners. Can you speak to how NRCS can increase transparency and accountability as an application moves between the state office and the national office or FPAC Business Center?
Yeah, this is Jerome Faulkner, and I can answer that. For the ALE process, we have actually last year we introduced part of our ways to improve communications with our entities who are in agreements, and part of that improvement is a standardized letter that NHQ has provided to state offices that provide an update of where you are in the ALE process. So at critical points in the easement acquisition or in the agreement process, the state office has standard letters that tell you, hey, this has been submitted, this application has been pre-approved, and we are now submitting it to provide all the agreement terms. So we have a standard part of our process improvement and streamlining that the chief wants us to do for all programs is providing these standardized what we call check-in points for state offices and for our state field offices to use to provide feedback to our program participants.
Thanks, Jerome. The next question, does 2 CFR 200 apply to program agreements?
I'll answer that while I'm on. The 2 CFR 200, which is, for those that might not know, 2 CFR 200 has to do with grant and cooperative agreements with federal entities. And so the program agreement and the parcel contract are not grant or cooperative agreements. So they do not have to follow the 2 CFR 200 requirements. So those program agreements and grant parcel contracts don't have to go through review to our grants agreements division. We use the program authorities that we have to enter into those agreement documents, agreement contract types, just like we use the program agreement authority in some of our other non-easement programs such as Equip and CSP. We use the program agreement authorities to do the program agreement parcel contract. So that is one of the benefits of having a program agreement and using the program agreement and parcel contract is no longer having to complete some of the standardized forms that are associated with 2 CFR 200, such as the 424, the standard ACEP-ALE, or having some of those forms that are not relevant for the purposes of the program.
Thank you. The next question is the timeline for the new policy manual and updated/revised forms.
This
Jessica,
is Jessica. Yep. So the goal is that we will hopefully have the new policy manual posted. I am hoping it's next week. So states will have a little bit of time to digest that. And then probably in the, I'm going to say, week or two following, the states will likely receive a series of, our NRCS folks at the states will receive a series of national bulletins that will cover things like fiscal year 20 implementation. So that's where things like the updated statements of work for the cooperative agreements, the new minimum deed terms, those kinds of things would be would accompany that implementation guidance, which is probably, I'm going to say, 3 weeks out, somewhere in that neighborhood. Additionally, there will be separate bulletins that the states will receive specific to things like program agreements, which I hope will come out in that same sort of 3-week timeline. The other thing to let everyone know is that there will be a new application for ALE, and so the states will be provided guidance. But for those of you that have applications that have been previously submitted but that you want considered for funding in fiscal year 20, you will need to submit on those new application forms, because now those new application forms include some of the things that we talked about today, what your proposed non-federal share structure looks like, some of those kinds of things. So the states do not have those yet. Those will come out with the implementation guidance, but just to give folks a heads up that some of those things are coming as well. So hopefully over the course of this coming month, the states will have the bulk of what they need to get things up and running for this fiscal year. The other one, maybe I should mention, there was a question about the AGI waivers. So there was authority included in the statute for waivers of the adjusted gross income limitation. Those are attached to the Farm Service Agency's regulations, which has not been published yet. So the states certainly don't have any information about those AGI waivers yet. It's not so that will all be forthcoming, but it's on a slightly different time track because those sit in the Farm Service Agency regulations.
Thank you. Okay, then we had a couple of questions about certified entities and whether or not entities that were certified under the 2014 Farm Bill need to reapply for certification under the 2018 Farm Bill, and how long does certification last?
This is Lisa McCauley. I'll take this one. Certification, if you were certified under the 2000 Farm Bill, you should have received a letter for 2019 stating that you are still certified under the 2018 Farm Bill. And you will be getting another additional letter coming up here saying that you will still be certified for this next Farm Bill. So farm certification does last for the term of the Farm Bill, but at this point we are just extending into the next Farm Bill after the end of the previous one. So we're not having you recertify.
Thank you. Under the buy, protect, sell, it says that the land must be sold to farmer or rancher at the lesser of 1, original purchase price, or 2, the agricultural value as determined by an appraisal. Is the agricultural value the encumbered value?
This is Jessica. I'm going to go with it could be. the agricultural value requirement was a statutory one. We've worked with our appraiser to sort of try to talk through what that agricultural value concept would look like. Certainly it could be the encumbered value, but if an eligible entity proposing one of these transactions proposes some other mechanism or not a mechanism, but some other value, then that, again, that falls into the category of things that we would look at when we review those individual transactions, but certainly it could be the encumbered value.
Thank you. The next question is, who determines and under what conditions are state ranking items decided upon? Is there any way to participate in that process?
Yeah, I'll answer that one. The state office determines, NRCS state office working with the state NRCS state technical committee in consultation with their state technical committee, and determines what they will use for ranking in their individual states. Some of there's national criteria that they have to include for state, and there's categories for state criteria. And if you are an applicant of ALE, and you can't participate in determining what those how those ranking. You cannot participate in evaluating or providing input as a state technical committee member. But the state technical committee is comprised of many different state-specific organizations that provide a lot of technical expertise for NRCS, so not just in ranking, but in other programs.
Great. Thank you. Okay, and there are a number of questions regarding Buy, Protect, Sell, and we are going to defer those questions to an upcoming webinar where we'll provide, well, we being NRCS, will provide an in-depth briefing on Buy, Protect, Sell. So we'll put those on hold for just now and move on to the next question. In the past, we are required to put a dollar figure on our entity contribution in advance of closing. How would these new non-cash items that are incurred later in the process up to and including the closing be handled? And I think, Jessica, would you be able to answer that one?
Sure. So what we have drafted is that effectively what will happen is on the application itself, you would provide an estimate. So you would, like Matthew discussed, you would provide an estimate of what your anticipated entity cash contribution would be, what the anticipated landowner donation would be. If those two items together don't meet those minimum federal share requirements, only then would you need to provide an estimate of those potential procured costs from that list. So the appraisal, the survey, closing costs, et cetera. You would provide that as an estimate on the application, and then on the 230 form, which is the statement to confirm matching funds, at the time that you actually submit the payment request, at that point, you would then identify effectively your actuals. So again, you would identify what your actual cash contribution waiver or your cash contribution amount is going to be, the actual landowner donation amount, and then you would provide the breakout of your costs for those procured items. So in this case, the 230 would actually, you would identify those, the amounts of those procured costs paid by the eligible entity and by the, and if any of those have been paid by the landowner, you would identify that amount. And then as Matthew said, but at that point you would know the actuals, you would be submitting that as part of the materials you submit when you send your payment request. But only if you are actually relying upon those costs to meet the minimum non-federal share, would you then also have to submit the receipts to go with that. So if items 1 and 2, the cash contribution and the landowner donation, meet the non-federal share requirements, which in most cases they would, because the landowner donation can effectively be anything not being paid by NRCS or the entity, then only in those cases would those actual documentation of receipts have to be submitted. So hopefully, I hope that answered the question.
Thank you. Once a program agreement is signed, can you add additional co-holders or third-party right holders?
I can.
So, oh, you go ahead, Jerome.
Okay. Yeah. Sorry, Jessica. For program agreements, there is the ability. So the program agreement itself, you can later on add additional entities that may have rights, such as co-holders or third-party rights holders, during the time in which your program agreement is active. And so it will have the functionality. It does have the functionality to add additional holders. I do encourage you to at the beginning, when you're thinking of all your entities that may be involved, one of the benefits of the program agreement is that you can add all the entities that you may be involved with, even if you don't anticipate actually having any of those funded in ALE. So, but yes, you could add them later also.
Thank you. And then I think we have just one more question regarding the administrative elements of the 2018 Farm Bill and the interim rule, such as modification, termination, and exchange. Just wanting to understand the rationale behind the 10% limitation related to modification. To put it another way, the rule says that modification cannot impact more than 10% of the property. So trying to understand the rationale behind that provision in the interim rule.
This is Jessica. So in general, the modification requests and things like that we see are for sort of those, I guess, unanticipated, circumstances. But to the extent that those things can be anticipated, they should be in the initial configuration of the easement. But typically, what we see are things like rights of way and various infrastructure and those kinds of things. So the part of the thinking is that those subsequent changes should have a minimal impact. Ideally, they have no impact, but if we find ourselves in a situation where there's going to be an impact to the easement, it should be minimal.
Great, thank you. So I believe that is all of the questions that we have today. Before I turn it back over to Cris, again, I just want to say a huge thanks to everybody that joined us for the call today. Big thanks to the NRCS Easement Division staff, and then let folks know that upcoming there will be webinars on buy, protect, sell transactions and ALE program agreements, just more in depth on the new process and associated documents. And with that, I will turn it back over to Cris, and thank you to AFT for co-hosting this with us.
Well, this is Cris. Thank you all very much for staying on. Thank you, Jessica and Matthew and Lisa, Jerome, Lori, everybody here in the room with me from AFT. And we will be back in touch with the links to the webinar and with information about the future webinars. So thank you all very much. Take care.